More on the latest oil inventory figures. Stephen Schork joins us now, editor of the Schork Report. Stephen, I want to hear your take on the IEA and their pretty cautious demand outlook, but just walk us through the latest oil inventory figures. Did anything jump out for you?
No, absolutely not, Andrew. The only thing I would say that jumped out was that it was a very calm report. It was a very flat report. And given the two recent reports, the absurdity of those two reports, which of course were greatly impacted by the power outages in Texas, where we had builds in the crude oil of tens of millions and the equivalent of draws in the products. So even as bizarre as the previous two reports were, Andrew, when you net out the crude oil builds against the drawdowns in gasoline and diesel supplies, net, the inventories were essentially unchanged over the last 2 weeks. This report, what we've seen right now, were the large build in crude oil. We even had two small builds in gasoline and diesel fuel, and that's atypical for this time of the year. So this was a flat report, but given the fact that we had atypical builds in the products, it was certainly skewed to the bearish side.
Skewed to the bearish side. What about US gasoline demand? I mean, that seems to be a crucial swing factor in the global market right now. Is that coming back, Stephen?
Yes, absolutely. The product demand, Andrew, has been the darling of the complex. Even through 2020, even at the worst of the COVID lockdowns, demand for diesel fuel held steady and continued to rise for all distillates, of course, with the exception of jet fuel. What we've seen now, Andrew, over the last 2 months, has been a shift in the forward curve on gasoline. So the way we're pricing in gasoline for the summer months is certainly indicating an expectation of rather strong demand. And then when we net out gasoline prices on the New York Mercantile Exchange against the ICE Brent crude oil contract, which is your effective crack spread for the New York Harbor market, gasoline has been outperforming the Brent market in the summer months. So once again, this is the market's tell that they are expecting stronger demand, certainly stronger demand relative to a year ago, but even stronger demand relative to the prior 5 years. It's painting a rather bullish scenario at this point, Andrew.
How about the IEA, though, the International Energy Agency, Stephen, saying that global oil demand won't get back to its pre-pandemic level, they think, until 2023. And even after that, they're looking for fairly slow gains in global oil consumption.
Well, I'm not going to go out that far, Andrew, because as you know, you only forecast 2, 3, 4 years out because you're trying to make astrology look respectable. But what we're seeing now with regard to the pricing in the market, clearly demand is on back. I mean, surely with the introduction of alternatives and how that has been ramped up during the pandemic, that certainly is going to eat into the elasticity demand functions for oil products. But what we can say now is oil demand, gasoline demand is strong, going to get stronger as the global economy opens up into the summer. So certainly, yes, I'm not going to argue with an assessment that goes 2, 3 years out into the future. But from the here and the now, what we're expecting to see is what we're already seeing is very strong demand relative to where we were a year ago. And in fact, Andrew, when we got the numbers out yesterday, when we look at the ratio between wholesale inventories and retail gasoline sales, we're right back into the historical metrics. So even though we took a hit during the COVID pandemic, the market is back into balance and demand has been the leader. And of course, supply, we're looking at a very hawkish OPEC right now that has been taking a very conservative view on adding barrels back onto the market. And that is certainly helping to put a floor in the market.
Yeah, just talk to us about the game OPEC is playing here. They don't seem to be worried about over-tightening the market and pushing oil up too much, Stephen.
Yeah, exactly. The OPEC kind of bamboozled the market a couple of weeks ago when it decided to kind of hold status quo, when I think the market was really expecting them to increase output given the rise in price, given the rise in demand. OPEC zigged when we all thought they were going to zag. When we replay that, we kind of have to start to play into the geopolitics and what has been going on this year with regard to Saudi Arabia, because, of course, it was Saudi Arabia that took the hawkish view in that meeting. And with the way the United States and this particular White House is treating Saudi Arabia, i.e., they're not talking to MBS, the de facto head of Saudi Arabia. They're going to his ailing 84-year-old father. That's a clear slap in the face. We're starting up the nuclear negotiations again with Iran. So that's certainly not going to please the Sunni Arab world led by Saudi Arabia. So we're back into a situation where geopolitics has been injected back more than ever into the OPEC decision markets. And let's face it, today, President Biden called Putin a killer. Okay. Russia is also a contributor to the OPEC plus decision-making process. And so slapping the two largest leaders of that consortium by not talking to the actual leader and then calling another leader a killer, you're really not making friends here, and you're really setting the seeds for a more hawkish OPEC going into the summer.
That's interesting. What about WTI, Stephen? Is there any chance it gets to $70 in the foreseeable future?
Certainly. I think we're in the midst of a pullback here, Andrew. What we had here is for more of 2020, the forward market traded in contango. That is to say that the spot market traded at a discount to the forward market. So there wasn't enough demand to clear the supply in the spot market. But beginning at the start of this winter, we moved into backwardation. That is, spot prices started to move to a premium to the forward market. So we were having a clearing mechanism in the spot market. And that was one of your bullish fundamental telltales back at the start of this winter. But for the past week, we've seen the spot market now dip back below the nearby forward market. So we're getting a market where the market is a bit balanced. We're potentially in a pullback. We are in the weakest demand part of the season, Andrew. We're in the refinery turnaround season. So the refineries, the only people out there that actually buy crude oil, are not buying as much as they normally will. But within the next 2 months, as we ramp into summer demand, the refineries ramp back up. You do have the table set for WTI potentially at 70 plus barrels going into the dog days of summer.